So the performance of the Cornelian fund range over the 3 months to the end of May, I would characterise as being reasonable in the context of a very volatile environment for financial markets. Markets were very much whipsawed by developments in the United States with the trade policy announcements on so-called Liberation Day in April, which saw the US stock market fall almost 20% peak to trough before recovering towards the end of the quarter. And amidst all of that chaos and volatility, I think the performance of the funds was reasonable, ranging from between +1 to -2. And the key drivers of the performance were really resilient performance from our fixed income investments, which are predominantly short-dated investment-grade corporate bonds, which provided that stable yield during the period. And then in addition, our diversifying assets also provided a helpful offset to equity market weakness, with positive returns generated by real estate, infrastructure, and absolute return. Well, I think both the decisions by the Bank of England and the US Federal Reserve were largely expected. And so I don't think they really moved financial markets particularly. But I think a much more relevant development has been the spike higher in longer term interest rates. And by that, I mean investors demanding higher yields from lending the UK and US governments money for longer time periods. I think that reflects, for the first time really in a generation, genuine concerns about the fiscal solvency of developed economies. And that has pretty profound implications, and that's something that we think about a lot. Well, the funds remain reasonably cautiously positioned, and indeed we actually reduced exposure to the equity market both pre and post the announcements by the US administration. Our view remains that the economic environment remains quite uncertain, and that valuations, particularly in the US, don't discount or do not adequately reward us for that uncertainty. So we're really focused on diversification and resilience. We've been adding to areas like infrastructure and absolute return. But bouts of short-term volatility always create opportunities, and we took advantage of that to add to some of our favoured companies listed in the UK that we felt had been sold off unfairly during the market-wide panic. So I think it's very difficult to predict with any certainty what the impacts are going to be of both trade policy, but also more importantly, to my eyes at least, the fiscal plan that is currently being proposed, which involves the US running an unsustainably high budget deficit with a full employment economy for the foreseeable future. And I think the US economy is going to face a number of headwinds from here, based on a lack of confidence because of the chaotic policy regime, but also the ongoing challenge of higher interest rates, which are the logical outcome of the expansionary fiscal policy that President Trump is promoting. So for us, real estate is a core asset class. If you go back to basics, what we're trying to deliver is long-term inflation-linked returns. We think real estate as a yielding asset class with growth fits that bill perfectly. What's quite interesting though is that the market doesn't really seem to agree with us. And the stock market values real estate at a much lower level to the actual physical real market. And you're starting to see that change. And that's why I think this year is going to be a really positive year for real estate. We've already seen one of our companies be taken out by a US peer. And another of our companies is currently subject to a three-way merger and takeover battle. So we think you cannot have a sustained disconnect between the private markets and the public markets. And I think that's going to really drive the returns from here, because fundamentally, some of the best real estate in our economy is available in the stock market. And we think we own some really exceptional portfolios. I think the announcement by the German government was a genuine positive surprise. The plans are significant in scale, and they fundamentally address a long-standing weakness in the German economy, which was that they generated huge trade surpluses, but at the expense of the domestic economy. By investing more than $1 trillion over the next decade in a combination of defence and infrastructure, we think this can provide a very significant boost to the domestic German economy and also increase growth across the EU. But I would caution a little bit about the benefits in terms of timing, because it's going to take a while for a lot of these projects to come through, and the stock market has already moved to discount a lot of that good news. The Cornelian portfolio has benefited from a re-rating of European equities in response to this news, and we have a reasonable exposure to the European economy, both through exposure to European equities, but also our UK listed businesses with exposure to Germany and other European markets. So we remain generally cautious on the economic outlook, cognizant of the myriad of uncertainties facing the global economy. However, we are very confident in the outlook for our portfolios. And that's because we think we can find lots of different opportunities that are not particularly dependent on strong economic growth, whether that's infrastructure or real estate or fixed income. We think there's a lot of attractive building blocks in our portfolios that can deliver attractive returns from here and provide that resilience in difficult times.